All right, we are live. All right, so today we're going to be discussing the earnings report that happened today with our guest speaker, Auditor Dan. Go check out his YouTube channel as well. Be sure to do that. And I'm going to actually kind of give some background to, I guess, the times that we've spoken about SoFi in the community. By the way, if you guys don't recognize Dan, Dan's a longtime member of the community as well. So we've talked about SoFi, I guess, quite a bit, almost like as a joke, because it's just this very popular YouTube stock for whatever reason. I don't quite get it. It kind of came out of that SPAC craze. It originated from the let's say, very famous SPAC king, Chamath Palihapitiya. And from there, it kind of progressed into some sort of retail darling. And I don't know why retail is choosing these companies as its champion. So I want to not take over too much. Dan, what are your kind of initial thoughts on SoFi before we get into the earnings report, so the audience at least knows where you're coming from?
Like you said, I tried to figure out originally like where this came from on YouTube. I never really could figure it out. The only thing I could think of is that the Kathy Wood innovation type channels maybe just latched onto it when the whole ARC thesis failed. So they had to find a new, idol that they could do videos on their channel. But yeah, like you said, it's really strange. But overall, like I've been harping for months and months on. I've tried to write articles on Reddit and other pages that their credit loss allowances are just absurd compared to other banks. I've never seen anything like it, and their loan book is just—it's the most degenerate thing I've ever seen in my life.
I'm going to stop you right there. Their average credit score is pretty high, so that dismisses what you're saying.
Oh yeah, I guess we can end the stream.
You're wrong, because the credit score is high. So yeah, what you're kind of getting at is there's basically two ways to look at this stock, and you either are looking at it from a banking perspective or a technology perspective, or both, a bit of both. But from the banking perspective, right, you're pointing out truthfully, accurately, that it's not the best kind of bank. Well, right now we can't really judge it on actual like metrics we would normally look at a bank. I know that retail has fallen in love with price to book, which is really unfortunate because it's been bastardized at this point. But usually when you're seeing a lot of people just throw out price to book as a valuation, if you dig a little bit deeper, they don't really know why something is trading at a particular price to book. And you were kind of getting to that point in your statements and your opening statements about SoFi. And that has to do with the risk profile of the book. And what do they hold as a majority of their loans?
Well, last year when I did a write-up on Stone Cold, it was like in the 70 percentile personal loans. But I was just looking at this quarter. I mean, it's even higher now. They're really leaning into personal loans even more than they used to. I've never seen a bank look like this. I mean, maybe a firm looks like this, I guess. I don't know. that might be the comparison. And the whole spin about I'm an accountant like Chris. So, you tell me it's a fintech, but I look at their numbers, it's a bank. They make their bread with loans. So like the whole fintech narrative makes no sense. Galileo is not growing. I've seen that for months now, and I know people are going to watch this and think we're just piling on now. I mean, I've been following this thing for over 6 months, and the main thesis of why this is a bad investment, I don't think it's changed. I think it's getting worse, actually.
Yeah, and especially that was another fascinating thing. So I know that, yeah, exactly. So people were watching and haven't seen us before. And Dan wasn't making videos back then, but as a community member, he already held this opinion. So I'm going to back him up here, say, yes, no, he is not piling on. He's had a negative opinion for quite some time on SoFi. But that being said, there are major criticisms that I feel like have been dismissed for quite some time, when you kind of take into account the macro environment as well, this is, at least from the banking side, we'll get to the tech side. The banking side is perhaps one of the last things I want to get involved with. One of the last things I want to get involved with, which is personal loans. Forget the student loans for now, but the personal loans is what they're, again, like Dan said, kind of doubling down on. That's how they create their spread. If you look at the interest they charge on the personal loans versus the interest they provide to you in your savings account or checking account, they're generating a good spread. But think about all the risks that they're taking on. With a bank, you have to worry about, let's say, the risk adjusted return of the bank. Primary focus of a bank is to get paid back. And then if they can generate interest on, or generate a spread on what they borrow cash for and what they can lend it out for, that's the makings of a solid bank. You can think of, on a high level, 10,000 bird eye view level, JP Morgan Chase is kind of like your bellwether, your gold standard bank. And you have a low duration risk in that bank. I think they have, I forget the number exactly, but I think their portfolio or book matures on average at 6 years, which is pretty unheard of, especially for their size. They generate really strong return on equity on that book. Then you have Bank of America, which is about 20-ish years, so completely opposite strategy. They buy up assets, they hold it for a very long time. They extend themselves to that duration risk, but they manage it well. And then you have kind of the smaller banks that still do that, like US Bank, which is low duration. They just have credit exposure right now to CRE loans. But going back to SoFi, you're taking all that, put out that to the side, because we're gonna say no. That's not enough. We're gonna go on the total extreme end of the risk curve, and we're gonna put most of our loan book into personal loans, which I get it. They're trying to get into the other stuff, and I experimented trying to see like how easy it is to try to get like a mortgage on SoFi. And no, they were very, I guess, persistent on trying to get me to borrow from them. At the end of the day, by the way, they couldn't match the rate, but that's because of a relationship I have with another bank. But it's competitive. I'll give them that. I'm not going to say it's not competitive. But the point is, they really don't generate that much business. And the whole argument that they're kind of targeting that higher income group, I don't really see it. And every time we talk about personal loans, something doesn't add up there. It's kind of strange to me. I don't get that. But some people,
I think somebody I think it was Mark. Uncultured Currency mentioned that like people that are more well off, so the higher fight, they're saying they're targeting these higher income people. Like you have resources at that level. Like for me, I can take out an equity loan on my house or my apartment. I can take out a margin loan on my bank or my brokerage account. I mean, I can take out a cash advance on a credit card that I have for business expenses. So for me personally, I don't need a personal loan. I have no interest in any personal loans. And I'm nothing. I'm just someone in the middle. So this whole narrative that they're going after high income earners, I don't see it. Like, and then there's other ways you can get loans that are not personal loans that I've been offered before. So it's just like it's just stupid. Like,
they're probably maybe comparable to a lending club in that respect. But to answer Andrew's question here, the net interest margin was something like 5.5. I want to say 5.5 on the average. I remember from the earnings call. So it's not terrible. It's not. But the thing is, like, in order to generate that 5.5 or whatever it is, 5 something, then think about the risks that they're taking on. I know Andrew definitely knows this. And Andrew, by the way, love the photo. That's a wonderful photo. But to Lincoln's point here, no, they're not suffering from the same issue. So FRC suffered from a liquidity issue, not from a credit risk standpoint. SoFi, to my knowledge, when I took a look at it, isn't suffering from a liquidity issue. In fact, I believe deposits are up, but there's other things that can go wrong. Banking is complicated. It turns out, banking is complicated. I know it's crazy to say, but
So one interesting. So I've never seen him asked about the credit loss issue until this. I was just skimming the transcripts. He did get asked about it this time, and he said they're missing their target, but Noto said the target for loan losses is 7 to 8%. That's their target, which they're missing. They're almost 12% on their 10K. So they're not even, I mean, really, they're not even close to that. And even if they got to that target, that's pretty egregious considering I think last time I checked, Wells Fargo's credit loss was like 2% ish. And JP Morgan, I think, was below like 1.8. So
yeah,
he's just, you're talking 8 to 10 times worse on this loan book.
no, JP Morgan is going to be like the gold standard in pretty much every business line of banking. So it's not fair to compare it to them. But
yeah, I tried to I didn't look at the hell is that? That degenerate bank. I don't know. Ally.
Ally Bank.
I didn't look at that one,
but Ally at the very least, because for the audience, auto loans are considered to be degenerate forms of lending within the banking world, but it's it's not that degenerate. SoFi was like, no, auto loans, that's not enough. We're gonna go again to that extreme end of the curve, and I know that bulls have made the argument that they're going to have an advantage in selecting for those loans because amongst that massive ocean of personal loans that occur, well, it's not that big, but it's big. They can be the ones to select the customers that are definitely going to pay them back. All right. So, but what Dan's just illustrating is that their target was 9%. But in fact, they're coming out at 12%. So that's already a negative right there. So they have 12% delinquency. Did I hear you correctly?
That's on their 10K. It's 11.85.
There you go. So they're missing that mark, and they set a goal for 9%. You could believe them that they're going to hit 9% eventually. But the point is, right now, what they're executing on there is they're not meeting that goal. And then there's the other side of SoFi, right? Where and again to Lincoln's point, some people don't look at SoFi as a bank investment. They look at it from the technology side. They have the two main businesses, which is Galileo and Technesis, something like that. Technesis, I think, is the pronunciation. And with Galileo, you have kind of like that. They service a lot of fintech. So I'm going to defend them here, okay? But I want to bring this up. And I know, right? I'm going to defend them, but not really. It's like, relatively speaking, I'm defending them. So let's go to, where did I put it? Hold on, let me get the.
You want a slideshow?
Yeah, I have the slideshow pulled up, and I'm going to pull it up for everyone so they have a visual. Here we go. So this is probably the most, I guess, stark slide right now for those who are investing it for Galileo or technology. So I'll let Dan say what he wants to say first, and then I'll say anything that I feel like I want to highlight.
I would try, or if I'd go to page 15,
all right,
talking about Galileo, just
15. Let's go.
Are we there? Oh, okay. So this is one thing I've noticed, like the whole mantra Galileo is this fast up and coming technology. It's exploding. This is what they're telling people. If you look at the top line of the technology accounts, yes, it is growing fast. But then when you actually look at the bottom number, the actual profit from Galileo, it's pretty much flat. So people, I don't think retail understand, like a growth company, they really push the revenue growth because that's what Wall Street expects. So they push that narrative of revenue growth. But at the sacrifice of it's not growing in profits though. And you can even like the bottom line of the technology segment. It's like I looked at that a few months ago on their one of their quarterlies. It's just unimpressive growth for what they're telling you it is.
Yeah. So for at least we can see that the margins have to be compressing at that point. If contribution profit is remaining flat or not growing that much, but revenue's growing. What is that, like a 30% clip on the year-end comparison? And on the, let's see, quarter over quarter, it didn't really even grow that much, 124 to 130. It grew, and then contribution profit from quarter to quarter fell a little bit there. But throughout the whole year, each quarter, it's flat, relatively speaking, and the revenue clip growth clipped out at yeah. But either
This is
way,
the part, like a story investor, you hear them talk about it. They talk about it exploding growth. You see the revenue, but then like you have to combine it with looking at the financials and be like, the story they're telling me is not what's on the paper with this company. And this is where a lot of these YouTubers are failing. They're failing so hard. I can't, and I'm not even like an expert on banks. I'm just some auditor that works in the government.
For Lakers and Ford, no, you really couldn't say this about Salesforce. So you could, the thing with Salesforce is pretty much consistently from the get-go, you could see the margin expansion. They sacrifice short-term net income profits for the business, which, SoFi's already doing. But the actual product segments, if you were to break them down, you would see that they are contributing nicely. They're growing, or they're kind of moving in line. What you do see, or what you should be seeing, and this is the argument from these growth companies, is that they take a lot of those, let's say, operational profits from the products or contribution profits, to be more precise, and they reinvest it back into the business. So you don't really get anything down to the bottom line. You get maybe more expenses to expand and expand and expand and expand and expand. And so Salesforce wouldn't be a good example to compare this to. This is, again, the market can be wrong sometimes, right? And but more often than not, it's not. We kind of are trying to say, well, what is the reaction? What caused this reaction, the sell-off that we saw today? And I'll go ahead and pull up the stock price to show you guys. It's down about 12-ish% on the day. And well, let's kind of bring out about that discussion. What caused the 12.2% decline? And that's what we're trying to get to the bottom of here. So this is one component, right? Well, something to highlight. From the technology side, we see margins are compressing. We are seeing them not really execute well in terms of loan loss provisions. We're not into loan loss provisions, but maintaining those delinquencies or getting to their goal, at least for now. But I'll give them a pass on that for now. It's a tough environment. Going to, what was it, slide 5. This is, was it slide 5 or? Yeah, I think
it was the next.
Yeah, slide 5. This part is definitely concerning from that narrative. Okay. But I have a defense for them. I do have a defense for them. But I want to know if, Dan, you want to share first, and then I'll go. Or if not, I'll go.
No, you can go. I don't have a good point here.
All right. Well, it's clear to see here, right? They did have year-over-year growth of 15%, but the quarter-over-quarter growth is what is concerning. Okay, but this is my defense to them, okay? Because I want to be fair. That's more than likely, because think about the customers that they have. The customers that they have are other fintechs, right? They service a lot of other fintech customers. We know some of their names. We don't know all of their names. And there's, of course, rumors that they're going to get some sort of larger client that I saw around there. That's the one thing about, I guess, these YouTube stocks, is that you have a lot of people talking about them. So rumors spread around, whether true or not true, I don't know. But maybe they do get this really big client. I know that from the strategic shift from the business, they're going to try to focus more so, what it seems, on larger clients rather than smaller clients, because there is a benefit and a drawback. So the benefit of smaller clients is shorter window of closing a deal, right? With a small client, you know, it could be a couple months, maybe 1 month, maybe even, like, if it's crazy, like a couple weeks. The point is, it's shorter. With a larger client, you're looking to extend that window. You're not looking to, but that's just the result of the size. Typically, the window to close a deal is much larger. Well, and then the benefit is what's it called? The term churn, the churn rate. So you're not going to churn as much on that larger side. Those larger clients, once they kind of get into your platform, the idea is hopefully that, you know, they're going to stick around a lot more. The smaller ones, you more often than not see a lot more churn. So that's another benefit from going big. But okay, so that being said, this decline here, this slowdown, and it's a decline quarter over quarter, is very concerning. It's a chink in the armor to the narrative, right? So again, answering that question, what is causing this decline today? I believe it has a lot to do with this and the margins, maybe, and some of it had to do, and we're, you know, at the end of the day, we're just speculating on the really what the market was pissed off about, but it makes sense to me that market would be concerned at least with this narrative breaking, because what we would want to see is continued growth. My defense that I didn't get to yet. What's happening right now? Okay, what's happening right now in the startup world? Okay, think about how that actually might affect SoFi's performance, or at least Galileo's account growth. Right, it's a very tough environment. So now I will say this: if they go the wayside of, you know, I'm gonna be maybe careful with my comparison here, but hear me out on what I'm trying to say. Tattooed Chef, okay, scars. Everyone's scarred from Tattooed Chef, right? So Tattooed Chef, the company that individual who shall not be named pumped to Kingdom Come, said it was his next Tesla. What did we witness before our eyes, right? And keep in mind, I'm not dogpiling. Dan's not dogpiling on that. As a community, we have criticized Tattooed Chef for a very long time when it was like over $20 a share. But that story broke apart as we saw the revenue growth in the beginning, right? They were clipping out like 50% plus in some quarters. And then more recently, all that just went away. The growth narrative's gone. So if that happens with SoFi, for whatever reason, because there is competition. I know, I don't know why there's people that think there's no competition here. There is competition. And you can actually, I mean, there's resources that you can actually look within at least the private world where you can find businesses that operate in the specific services. But that's something that retail doesn't. And again, this is not my investment, so the onus is not on me to find those competitors. But they do exist. Off the top of my head, I don't remember all of their names. I think I talked about them in a video. But anyways,
there's one parallel, like SoFi, a lot of their presentation, they're talking about number of customer accounts, number of Galileo accounts. That's like the first slides. And when Tattooed Chef, if I remember, started falling, they started to highlight the SKUs. Remember, we used to joke about they had all these new products.
That's a great.
So now, they're very aware they're a growth company. I don't think retail, like, these people are aware they're a growth company. They have to keep the narrative of growth at any expense. So more SKUs, more customers, whatever they can generate for the excitement, because they're not making profit.
Correct.
So they keep pushing into that, and then it ends in a bloody mess at some point.
To reiterate, because some people out there might be very confused and saying, why are you comparing a food company to a bank? We know they're very different. We're just trying to kind of use an example of a narrative breaking within a growth story. Because that's what both of those are. Now, both were SPACs.
Yeah.
Both were SPACs.
But people think, well, why would they fight so hard to be a growth company? But it's like, it's great to be a growth company. You can issue shares. You know, everyone inside's getting stock-based comp. Nobody cares, right? So it's like the good days for them. Anthony Noto made $100 million last year. I mean, so it's great times to be, you know, working for a company that's a growth company. So
it's like venture capital.
They keep it going as long as they can possibly.
Yeah. It's like venture capital, but taking it to the public markets, right? So you're keeping that narrative alive, and you have a very similar mindset in your investor base. I want to see revenue growth at all costs. I want to see accounts growing at all costs. So that's not faring well for the likes of like Robinhood, for example. Robinhood can grow accounts all it wants, but I don't know how Robinhood long-term generates meaningful profits and kind of competes against these other institutions that have so many other ways to make money. So there are, for example, I want to say anyone out there, by the way, in the United States, I'm sorry if you're outside the United States, this does not apply to you, but if you're in the United States, look at the banks around you, check the brokerages, and see if having your assets in those, I don't want to say legitimate, they're all legitimate. Robinhood, I don't care what anyone says, it is a legitimate brokerage. You can buy and sell stocks. It's not a scam. It has features and gimmicks and all that, yes, but it's a broker. I'm saying from like, once you have serious money, right? Look at what your bank offers you, because some banks, I'll give an example, like Bank of America, and you don't even have to have that much money, by the way, to get status with these banks. You start to kind of compound that status, and you get perks that these other banks do not give you. Okay. And frankly, I'll give an example for SoFi. Beyond the interest that I get in a savings account, which I can find other accounts that give higher interest if that's actually my goal. And in the modern world, it's so easy to move money around. I find no reason to pile my capital into SoFi. Like I did because as a curious person, I wanted to see what all the buzz was about SoFi. I was like, what is special about it? What can it do that and by the way, I'm like the cutting off point of a Zoomer, so I'm like their target audience, I think. And I also have, I guess, their target credit score or whatever, but I don't find a reason at all to bank with them, because there's other banks that when I want to put my capital there, they offer me perks that are very attractive. And unless somebody in the chat can tell me what it is, and I'll like look into it, I don't see a reason. There was one time where they were offering a very good introductory offer for their credit card in like 2021. I almost got it. I think it was like 400 sign on bonus for
I
spending
signed up for
1,000.
like a savings account, and I got like $50 of SoFi points, and I just took it. And then I bought like one stock in their brokerage account, and it was terrible. It's so like clunky. I didn't care for that service, but I wouldn't bank with a bank that does crypto actively. So I mean, I wouldn't put any serious money there. That's just my preference, but
well, there's another component, right, to banking. I like a bank / brokerage that at a moment's notice, and this is again offering you more when you have more. You have maybe like a special line that you can call and have someone on the phone with you if something happens, which you don't get at Robinhood. Forget that. Like something comes up, good luck. Good luck. Have fun with that. And for example, I can recall one time where some information was improperly inputted at one point, and I didn't have like the margin account, right? Because you want margin so you can buy and sell stock, right? So you don't have to wait the 3 days, et cetera. So you get a margin account. And so like there was, I had opened up a new account, and I thought, I applied and all that. And then so when I couldn't do it, I fixed the problem very quickly. I got customer service, and then boom, it was done.
I double sold a stock once last year, but I called Schwab and I had it fixed in 15 minutes.
That's what I'm saying. Yeah.
So it's like, I didn't know. And then he talked me through because I had a bunch of questions, and the guy on the phone had he was able to answer everything. I didn't have to get redirected or like Schwab's great. But
Mighty Healthy says, pay back your student loans. I'm for that, by the way. I want to say, I don't know if I said something that made you think otherwise, but I'm for that. And that's something, again, that they had kind of, well, that's going away. I think the payments come back in June, so that's good for them, by the way. That's great. But yeah, if anyone out there in the chat wants to give me, by the way, this is a friendly space. No one's going to attack you or anything, but give me a reason why, someone would want to put the lion's share of their assets at some place like SoFi.
So I found how much money they have obligated to the LA Stadium deal, because it wasn't in their 10Qs, so it's in the 10K. So total, so long term, they have obligated $547 million obligated to the naming rights on that stadium. So it's and it graduates, so each year it gets higher. So I've been joking online that the Galileo profits don't even cover the naming rights to the stadium. And it's just like, and it's going to keep growing because as they're going to build out the LA stadium like retail area. So SoFi has to pay more money for the naming rights to the complex, not just the stadium. So it's over $500 million obligated to that for a company that can't make money. So it's very concerning. I would be very concerned about that if I owned the stock.
I would be concerned. Yeah, I did not know that.
I knew it was expensive because that's a very, lucrative stadium deal, I would imagine, for the NFL. That's their like home base that they envision. So
I want to say or bring up Andre's point here that you can get a real person. Okay, so back in my day, when I knew of Robinhood, and I guess that's like relatively new because that wasn't always the case. But yeah, back in my day, they didn't have the ability for you to really do that. So good they invested in that because that's important. You don't know when something bad happens, but I don't know to the extent, right, that it's let's say what are the wait times, et cetera, which they'll have time to build that out. I don't want to say that it's impossible and they'll never have something good and they're always going to be bad or whatever. I'm not a pessimistic. All right, so that's kind of covering the technology side, the banking side. I want to get into the price to book argument because that's another one that really just, and I want to maybe pull up SoFi's price to book here. So let's go to peer charting, price to book. We can see it like across time. And let's see here. Okay, so now it's trading at below price to book, therefore buy. And then it was trading at a low of about 0.78. So this has become a popular valuation metric among SoFi investors because they read somewhere that price to book is the best or a good way of evaluating a bank. It can be. I would call it basically as good as a PE ratio. A price to book is just as good as using a P ratio, which is to say, if you're new to investing, by the way, the P ratio is really good, kind of like a smell test, initiation, gives you like a quick bit of information. But I wish investing was that easy. I wish evaluation was that easy. And we could just stop at P ratios. We could stop at price to books. And we didn't have to investigate further. For example, with a P ratio, it doesn't tell you the margins of the business. How effective is the business? How is the business generating return on invested capital, for example, just adding another metric, bringing it in. A P ratio doesn't tell you any of that. It just tells you the price in relation to its earnings. And even in those earnings, you haven't expanded upon that to kind of analyze, well, what's going on in those earnings? Is there any one-time things going on? Is there maybe something that's harming them right now, and the PE ratio is going to be a lot better the next quarter or the next year, et cetera? Similar price to book. Price to book does not tell me anything other than what the stated value of the accounting value of the business relative to what the shares are trading for at any given time. So with that being said, thank you, McBuda, actually, because I wanted to find some other banks to give examples to. Anyone heard of Deutsche Bank? Well, let me tell you, if you think SoFi is cheap, then check out Deutsche Bank at a price to book of 0.3. Or Citigroup. Let's pull up Citigroup, right? Citigroup's trading consistently at below book value. Just buy up Citigroup all day, every day, and you'll just do fine because look, it's trading at half. Why not?
I've heard certain YouTubers say that you should always buy banks under or price to book because if it goes bankrupt, you will get your money back guaranteed.
Someone said that?
A certain person. Yep.
Oh my God. Well, no, okay. they said it with like super like confident. Okay, well, anyways, no, because it's fine to think that when you're kind of getting started. Because yes, when you're first investing, I gotta remember, like when someone's first investing and you're watching this for the first time, you're new to investing, you're introducing yourself. You're like, okay, this is the P ratio, this is the price to book ratio. You got all these ratios. And then maybe you didn't study finance in college, and that's completely fine. You don't really need to. This stuff doesn't get uber complicated. These are all very, very simple forms of analysis. Just remember that they're very simple forms of analysis, and then start asking yourself the questions. Okay, well, what's the next thing? And then after you answer the next thing, well, what comes after that? So the questions, it's going to be your own journey. I'm not going to tell you exactly what guide to go through, but as an example is what I just went through. So you have price to earnings. Okay, well, break down that component of earnings. Let's break that down a bit. And then you can break that down into many different questions there. You can say quality of earnings. You can say how efficient are they in generating those earnings, which kind of goes into the quality. You can say, well, what are projections on these earnings? Are those projections? Do you agree with them? Do you disagree with them? And then you start to answer all these questions that kind of give you a lot more information that start out at the P ratio. Same with price to book, right?
Mm-hmm.
So it is not true that if a bank trades below price to book that you will get your money back. Actually, I'll tell you, FRC just traded at right before they died at, I forget exactly how below price to book it was, but it was nothing. So there you go. You could have bought FRC at literally pennies on the dollar on last Friday, and you would have totally been fine. You wouldn't have been fine. You would have been wiped out. So that's
I can understand. Like, I'm a newbie at bank investing. Like, that's why I came to your channel, like I've said, because you did a bank analysis or credit card analysis video like a year ago. So like the only thing I ever owned was JP Morgan, and it was because I knew Jamie Dimon's the man. The dividend growth projections I ran on it were pretty appealing when I bought it in like 2019 going forward. But I don't have any other. I'm out of all my bank investments. Or I sold that. So
which is fair. Just also kind of a comment I always give everyone is like, you can live your entire investing life, never invest in a bank, and do phenomenally.
Yeah. Like I looked at Wells Fargo and I broke it down, like what their loan book was like a month ago. I mean, I can do that, but like I can't put a value on that. Like, I don't know. Like, so I've steered away from banks. Like, I've stuck to things like I like manufacturers, companies that make stuff that I can tangible things I can value.
Yeah, banks don't make anything but money.
Yeah, that's what's always considered. I like a retail store. There's a box, and you can kind of value like what's that box worth to the company as they place it in different parts of the country. Or Caterpillar. I'm like, well, what the hell's a bank? I don't know. It's just tough. Like, what does a bank do for investors? And it's just tough to figure out.
Well, you're pointing out something that gets a little bit even deeper into the conversation about when you're looking at investments, the multiple expansion that an investment will receive in the future, at some point in the future, is a function of both the performance of the business, but also people's attractiveness to that business and understanding of that business. So the more not a rule of thumb, there's no such things as like rules in this world, but when you have a very complicated business like a bank, you have investors that just exactly how Dan is thinking, and rightfully so. They're saying, I don't get this thing, right? And they are very complicated. So that complexity deters a lot of investors, deters market participants. So you should see, on average, banks trade at lower multiples of earnings relative to other forms of businesses. Like, just the easy example, Pepsi. How easy is it to understand what Pepsi does? Right? It's fairly straightforward. And you fairly predictable cash flows, while a bank is very much not so. Pepsi is classified under consumer non-cyclical packaged foods business. And, whether we're in a recession, whether we're in a booming market, whatever, Pepsi's kicking along. Banks, you have to worry about, well, what's going on in terms of liquidity, which kind of coincides with macro. You got to worry about internally, what kind of loans is the bank managing to get? What's their cost of capital? All that kind of goes into macro, but pretty much you have a lot of different components that you kind of have to pay attention to. And not all banks are created equal. So every bank almost has like its own little niche strategy. Like I kind of was alluding to before, that Bank of America and JP Morgan are almost like two different banks. Not almost, they're literally two different banks in terms of strategy, right? Very different. And JP Morgan trades at a premium relative to all banks because of everything they're capable of achieving and what they have been achieving. So the market has rewarded them with that higher multiple. And if you look at JP Morgan's price to book, right, you would have been avoiding this guy because, you know, it trades at above price to book. Oh my gosh, price to book. I'm not going to buy this bank, Dan. It always trades above price to book. What is this? Except in like, I think, no, it didn't even get there in 2020. What is this? And then it was there, like, but it was basically trading at price to book. So you looked at Citigroup back in 2016, and you looked at JP Morgan. And if you were just using this metric, you might have bought Citigroup and missed out.
I mean, you have to imagine some of that premium is just because of the CEO, I would think.
Possibly.
Overbook. I mean, that's why I bought it. So
maybe we go with Bank of America. Maybe that's another example we can use. But let's go Bank of America. And I think this should allow me to add in like a Citigroup. Yeah. I'm only using large banks, by the way, because I could just throw in like smaller banks. But let me make this point.
Is pretty smart.
That's what I'm saying. I like using this as an example. It's a good visual lesson to
see. Like once I had looked at Bank of America, and I noticed a lot of, they're very concentrated, their mortgage business in like 3 states, basically.
Correct.
It's like California, Texas, Florida, New York, 4 states. So I thought it was yeah, they are very different, and that was different from what Wells Fargo's look like. But again, it's like I mean, I can understand what their loaning is, but not to value it.
Correct.
Because Wells Fargo was more Midwest region. So
to illustrate this separation, this beginning of the separation. So what Bank of America took a long time for it to really recover from the damage that it took. Same with Citigroup. So, but Bank of America did recover for the most part. They started focusing on a much more conservative buy and hold strategy for their assets. You do see that you do get opportunities under price to book for Bank of America, which for Bank of America is, if things continue the way they are, and that's kind of like the key, then they're a bit more compelling. You can see that sometimes they trade at a relative premium. And that's all right now. The concern is if you look at the duration, and Bank of America and Wells Fargo, they do have high duration, which is now what draw down in banks. But Bank of America and Wells Fargo are both pulling back. But just kind of cutting to the chase, saving everyone some time. If you investigated the duration, the average duration of the book of both those, they're significantly higher than JP Morgan. So, yeah. And let me just say that JP Morgan did make it out like a bandit on this FRC deal. Oh my gosh. That was good for them.
They get to pick the bones off it. As always.
Oh yeah. And Jamie Dimon was like, oh, we need to save. No, but he I think he legitimately did, but you know, he came across as like the I don't know how to say it, but like the guardian angel of regionals here. So
I mean, well, aren't the banks, I was talking about this with my friend. So like the banks are kind of incentivized by the way the structure is. When a bank fails, they charge the fees to the rest of the banking industry to cover the failure, like the deposit coverage. So you could almost argue they're kind of incentivized to, you know, help each other and not like let other banks fail. Maybe like it is such an unusual industry.
I just wanted to, I thought this was a funny comment from Slurpees. It's silly, but it's funny. Turns out they're different banks. So Zastar's comment here is actually good. Not that Zastar doesn't give good comments. That made it sound like, oh, this one's actually good.
Well, we had said we're like, well, FRC did survive a bank run, technically, like I would say at first, because I think it was 70 billion pulled out, and they only got like 20-ish billion in funds from like the bank. So, but it only went so far until the Fed stepped in.
Let me put it this way, Zastar. Okay, so you know how there's some loans, right, that you take out that are callable, like a callable loan. So like I lend you $1 million, and let's say it's a callable loan. So you could be doing everything fine with that $1 million. You're a great investor. Let's say you tie that money up in your house, and you're really good on your money. You're paying me back every time I ask for the interest payments. But I call the loan now, and I want my $1 million next month, right? Oh, you defaulted, you're bankrupt. Oh, so sorry. So banks, their entire business model is operating on that trust that you're not going to call the loan. Well, where's the loan at? Your deposit's a loan. You're lending money to the bank. When I go to Bank of America and I say, here's money, well, it's my money. They're going to hold it for me. That's a loan. I'm extending a loan to Bank of America. Bank of America gives me a paltry interest rate because they don't really need my money, but they give me an interest rate. That's their interest payments on the loan. That incentivizes me to loan them money. They're offering that to do that. SoFi, in this case that we're talking about, SoFi, is offering you 4%. And that's the loan you give to them. You put your money there, and then they're going to take that money, borrowing it from you, and go find another place to put it. So as long as you don't call the loan, withdraw your money, they're fine, right? Because they're going to be doing as long as they're doing everything right, because they could be degenerate, not doing things right. But as long as they're doing anything right, they're fine. So all that to say, every single bank is at risk of getting all their loans called. And the thing about banking is you take those loans and then you take leverage on those loans by lending out more than what you have. So, yeah.
We will talk about SoFi. If they had a big withdrawal of people, they would be just gone. Like there wouldn't be any week or two, or what did FRC make it, a month? SoFi would be gone in an afternoon. Like for people watching, like Anthony Soto is going to call Jamie Dimon to sell his personal loan book. I mean, how much do you think Jamie Dimon's going to give him? 5 cents on the dollar for personal loans? If he'd even want them, he'd probably just hang up and laugh. So like, it's a personal loan. Like, who's going to pay you? You're not getting anywhere close to dollar for dollar for that. They're just done with. I mean, they're like 80% personal loans. I don't think people really understand. Like, they could be gone in an afternoon. SoFi, it would be fast. Like,
yeah, that's again going back to my fascination with this company has been hung up on why retail chose this bank of all banks, why they chose this bank or fintech. Let's call it, fintech, whatever. And okay, I can get around the Galileo thing. I can like see that, right? Like I can see it, just like I can see like Palantir, right? I can see why they get excited about it. But like the banking side of this is so, I don't know. So
I really couldn't figure it out. I did look, I tried to figure out like, where did this come from? And I don't know.
I think it was momentum almost. Like Chamath got a lot of retail in. Retail now is kind of almost coping with the investment, and then has kind of taken the mantle from Chamath, because Chamath abandoned all of his SPACs pretty much, from my understanding. And Chamath has been just, fumbling the ball again and again and again. The Meta thing was hilarious. That was a big fumble. But,
I mean, there's a lot of YouTube channels that you could see. Literally, you go back, some of these SoFi Palantir channels, or Tesla even, they were Cathie Wood ARK innovation people. And then eventually they would make a video about like Sofi, and it would get like 10 times more views. So they were just random finance channels, and then they get like a huge amount of views on that, and then they just pile into that. And I saw it at a few channels with Sofi Palantir specifically. So I mean, I guess if you sell your soul to the algorithm of YouTube, then that's where it's going to lead you. If you just certain YouTubers we know, they were probably failing until they just found this one company that everyone wanted to watch videos on. Then they just latch onto it.
Yeah, and that's, we'll get to Julius's comment here. That's
I'm sorry, but I've made jokes with like Kingdom, so he would make a degenerate stock video, and it would get like 20x the views he normally gets. I mean, he could have just really pushed into that and just kept making video after video about these degenerate companies. Or you've done the same. You guys are aware of the algorithm, but you've chosen not to do that. You stick to what you believe is right. And there's not that many people like you Kingdom, Strongman, that you guys don't like dive into the algorithm. You don't sell your soul to YouTube, basically.
Yeah, I would be bored out of my mind because that's at the end of the day, YouTube needs to be fun for me in order to do it. Otherwise, I won't even do it. There's not really a monetary like benefit. If anyone wants to know, like, I mean, right now, like YouTube revenue is like just nothing. It has to be fun. So that's what it was from the beginning. It's fun. And so in order to get in front of the camera, I got to be, amped up. I got to be excited about the topic that I'm going to be covering. And so I don't want to be like, for example, arguably, if I wanted to kind of milk that algorithm, it'd be Meta all the way. At this point, I shouldn't be, making videos Meta this week. What am I talking about? Meta. Just keep showing my meta gains too. Just like keep showing my meta gains, blah, 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 blah. And it's just harping on that.
Well, like people ask you to make a meta video and you're like, there's nothing to talk about.
Yeah. You see me on Discord. People say, can you do another meta video? And I always respond, what?
What's the point? Like just to glorify. Yeah. It'd be like me making a Tractor Supply video. Like nothing's changed for me. I could just show green. I mean, I don't know. But
usually when someone asks me, and I'll tell you guys this, you guys, I might do an eventual meta update video because it's literally been a while, but usually when someone asks me, hey, are you going to do an update video on meta? I will just literally, or they ask for or ask me to do a video on meta. I will not make the video on meta, and I'll just say, just go watch my video from like November. Because if you've done proper due diligence, or what you feel like is proper due diligence, hopefully it doesn't last like only a month, right? Hopefully it lasts for an extended period of time and you've covered most of the bases. So my videos, when I do those videos, like my Netflix video where Netflix became a big position in my portfolio, go check out how long of a video that is. It's a long video. And if someone asked me, hey, what can you do a Netflix video? I'll say, no, just I'm not doing one of those again. Just go watch that. And it'll explain my whole idea behind it. And then same thing with Meta. Just go watch my 45-minute video or whatever on Meta, and you'll get an idea. And today, what's happening today, nothing's really changed from that time, only the price. That's it. The price is what's changed. So yeah, that's I can't do Tesla video, Meta video. I can't do that. It's boring. It's so boring. I know it's entertaining for like people, for audience members, but it'd be boring for me as a creator. I would hate it. So I want to switch it off when we're closing off this topic, because I know I want to be cognizant of your time, Dan. I want to ask you a question. Give us a light at the end of the tunnel. Now, it doesn't have to, it can be whatever. What is an interesting investment that you're looking at? Instead of just, oh, these are bad investments. Well, do you have anything right now that you're tickling your eyes?
I'm looking. Okay. I'm not so comfortable talking about ideas like you are, because until I map it out and actually like do something with it. But okay, I'm trying to figure out like what industrial companies in the chemical space could benefit from going forward, like EVs and hydrogen cells. because a lot of these future technologies need more chemicals actually than, so like an EV car needs more chemical components than a gas car. And I've been trying to work that out. And then also like, what's the future of recycling? Because a lot of these industrial companies are getting into recycling as a future business. So I have like 5 or 6 I'm looking at for those ideas. It's tough because like these are ideas that these won't flesh out for 10 years probably. So it's hard. I mean, this is the part I enjoy about investing. And that's kind of why I wanted to get my ETF, like I said yesterday, because I want to focus on very specific investments like that. I don't want to be bothered looking at like Merck or Home Depot's financials. I just want to have it in a basket, and I want to focus on these very specific investments that I'm good at, I think, finding. I'm not ready to talk. I don't want to really, and people say, what company? It's like, well, you haven't done the ground research, so how are you going to understand? And I don't have enough time to talk about it.
No, fair enough. But what you've discussed there is basically kind of bird's eye view, your strategy. So you're kind of switching it up now, where you're going to be mainly putting most of your capital into an index fund that follows your preferred strategy.
Mm-hmm.
And then outside of that, you're going to be trying to, basically find out what's your edge. What can you think that you can find out there that people overlook, and then put your capital in there. And then that's how you're going to get that extra outperformance, which a lot of people sleep on that. They want to be like almost like a jack of all trades. I'm guilty of that, by the way. I'm not innocent of that. But trying to basically find a good investment in a bunch of sectors rather than just focusing on a particular sector that you might understand a lot more, which, for example, I know some people that are really hyper specialized in, a different person, hyper specialized in tankers, right? We both know. Then I do know another person that's hyper specialized in medical companies. Oh, we also know another one.
There's so
right?
there's such interesting, like the future of plastics, even like the world, like we have to get to biodegradable plastics. It's going to happen. So it's like, well, okay, you have to figure out what companies, who's got the patents. So this is the tough part. Or does a company even have that edge yet? Maybe nobody does yet, and it's so premature. But I like those topics and thinking about it.
Yeah, there's
more future innovation beyond just Tesla and Elon. I get so frustrated that people are so fixated on Elon Musk and Tesla, what they're doing. And like there's a whole world of companies that are innovating decarbonization and future energy solutions beyond Tesla.
Cummins.
Nobody's going to watch those YouTube videos. And that's just the truth. Nobody's going to watch me do an industrial video about a chemical company or what Republic Service is doing with recycling. Nobody's going to care, but they want another Tesla video.
Let's rephrase that. There will be some people that care, and those are the people who you want in the end, because that's what, like, on YouTube, if you take YouTube as an aggregate, the crowd is going to underperform by and large because they're going to follow classic retail.
Well, I see, like they fall, like for one example, Cummins. I saw dividend investors start doing videos on Cummins Motors when it hit 250. I'm like, where were you when it was like 170, 180, when it was a great buy? And I was being called an idiot. But then it's 250, it's at its highs, and now all of a sudden all the videos start popping out. So they want to pretend that they were like part of those investments, these YouTubers. It's just frustrating because I think, retail gets the wrong idea, I think, if they just watch YouTube videos sometimes.
And that's, the whole YouTube finance space is littered with, like, the incentives are off, because I think a lot of people, it's hard. I don't want to be careful in bagging them for this, because if they're looking at it as like their stream of income, then okay, I get it, because your incentive is aligned with views, and you really want to just generate as much ad revenue as possible, and so it's vicious cycle, right? I actually was kind of almost like, I don't know if that's the right term, red pill / black pill to this, for specifically talking about within YouTube finance, that all the YouTube content creators that are degenerate, they are just a product of their audience. The audience created them.
You guys used to say, you were Echo, somebody, yeah, I didn't believe it at first, but it really is. I mean, I used to think it was the YouTubers' fault for creating the retail people or damaging them. I'm like, I mean, retail creates these people by your views, and then they see the views in the algorithm and they just give you what you want, basically.
Oh, so. Yeah. It's I guess it's addicting, right? To get that self, like, what is it called? It's
confirmation bias or something.
Yeah, confirmation bias. That's the word I was looking for.
Yeah, like these Tesla people want to believe Ford and GM are dying companies. They just want to believe it so badly. They can't listen to any reason. And then they tell me that GM and Ford have too much debt. And I'm like, you have no idea what you're talking about now. Like, you're clown country if you don't understand.
Oh, is this true? The algorithm is finally limiting recommendations on YouTube finance channels? Yeah, that's fine. That's fair. Because at the end of the day, it'd be cool to see finance YouTubers, and they cringe at saying that, by the way. I do not consider myself one. Who just make money from their investments. Huh? Right? Weird idea, right? Strange idea. But maybe, hear me out on this crazy idea. Maybe they make money from their investments. Oh shit. You know, that's a crazy idea. I should be quiet. That's a terrible, silly idea. It's definitely like, not at all that you should have like $40 million and lose half of it, then sell everything and then buy everything again and then lose another whatever half maybe. Yeah, nothing like that. No, right?
Nothing like that.
Nothing like that. Finfluencers. I cringe at that word. All right, so I'll say for me, because I'll give everyone, I guess, what I'm maybe looking at here. This year has been kind of weird for me, where I've only been pretty much buying supporter positions because I kind of closed my book last year. I gave a portfolio update. If you're new to the channel, go check out the portfolio update. It's recently posted. It's a live stream. And then you can see pretty much every portfolio update ever that's been on the channel. If you really want to go back that far and then see how it's changed across time. But for the most part, yeah, 2022 tail end, we kind of closed the book, and then everything's been supporter, having fun. Banks are pretty much the theme-ish here, sort of, but they're still small. In the personal holdings, you saw that they're small, and in the holding company that I know that a lot of you guys here have access to, there's not a single bank in that. So it's like, nibbles, right? And then real estate exposure still muted, even though I talk about it a lot. You see, that's the thing. I confuse people, right? Because then they say, they think capital minds say, oh, like REITs, right? They think REITs because I talk about it a lot. But if you look at my portfolio, it's what I don't talk about because I find no purpose in talking about Meta or Salesforce, Netflix, all of them. Anyways, right now there's an interesting company that was brought to my attention from actually audience members. I'm going to be making a video at some point. It's a hotel franchise. And then there's Brookfield, which I've already made a video on. That's one I'm accumulating. And as well as I think I'm trying to think of my itinerary for videos that I have to come up, but other than that, there is a REIT that I am buying, and I want to say, kind of commenting on the REITs a little bit. Hear me out, everyone. So the reason why I talk about REITs maybe a lot is because 2023 and 2022 they're really distressed right now. So I feel like there's just opportunity in there. And I've held that opinion now for several months now. I would say almost all this year. And I feel like there's going to be plenty of time to get involvement in them. I don't think there's like a rush to the door as to like, I need to have 10% of my portfolio in one REIT stock tomorrow. It's kind of like, you know, we can get there. We're going to have time. You bring up Vici. So I like Vici as a company. I like their strategy. I just don't think the valuation is there yet, but I feel like it should probably still do well across a period of time. Just it's very defensible. There is a outlier risk in, since about half of their NOI comes from Las Vegas. If anything were to happen in Las Vegas, I'm not saying something's gonna happen in Las Vegas, but if anything were to happen,
You're thinking what I'm thinking. I know you are, because I brought this up to a certain Bubbleson person a while ago when I was in his Patreon. I brought up concerns about water and Vici's exposure to Las Vegas.
Oh, I wasn't even thinking about that.
Oh, no,
share with
you
the
weren't?
audience. Share with the audience. Yeah.
Well, because I brought up, I'm like, the Hoover Dam was so low at that point, they were drilling new tunnels because the water levels were getting to a point where they almost couldn't generate power. So I asked him if he was concerned about Vici, and he hadn't even thought of that as a risk factor. Considering most of the electricity in Las Vegas comes from the Hoover Dam, beyond the water that they would use to drink.
Yeah, so that's something that people don't even think about. And so that's really interesting. Thank you for sharing that here. I thought that's where no. I was thinking just something. I didn't have a specific scenario, but thank you for sharing that specific scenario. So something that, you know, people, those are like black swan events essentially. Well, it's not black swan anymore because you've laid it out, but like they're outlier scenarios that people kind of think are not pricing in, and you know could be something. But I'm just saying, like, just the exposure, that's like the one chink in their armor. So I like Vici and all that. They have great properties. They have that serves as a moat, but it also is kind of a risk because if the operator goes bankrupt, who else is going to operate it? Someone has to acquire that and stuff. But that being said, that operator is probably never going to leave. And the rent escalators, I believe off the top of my head, are like maxed out at 3%. So there are inflation rent escalators, but they cap out at about 3%. I have a problem because I shouldn't have that in my head. That's a random factoid. So I need to find another hobby. No, I'm kidding. Why do I know Vici's rent escalators and I'm not invested in Vici? That's just pointless. Well, it's not pointless. You see, it was served the purpose for talking about Vici.
I've had periods where I bought REITs and fell in love with them in the past, and then I don't know. I had a phase where I had like Stag and EPR and LTC, and
it's like, okay, EPR is liked by retail.
You know about EPR? Oh, come on.
I know about EPR. I know about.
I've never heard you talk about it.
Well, it's because
I did buy it after COVID as a rebound play, and it did all right actually. But I didn't know. So I bailed on it after like a year. It worked out okay. It was an interesting read. It still is, but
yeah. I think with EPR, and they're doing it. So this is something, you know, like my kind of a philosophy of creating like a report card and grading management on their goals, and you set the goals. So their goal is to minimize or reduce their exposure to
the movie theaters. Yeah.
And they're doing it. And then I think movie theaters are going to be here to stay. Because, for example, I'm a huge advocate I want Netflix to get movies in the movie theater. I want that recapture event. That has to happen. So I think there's a huge place for movie theaters. It's just kind of narrowing it down to like the best movie theaters, the best locations. So if EPR shrinks their portfolio to those best locations and best operators, then they should do fine on that front. And that's what they want to do, which they already had the better locations. And then they expand into other segments. That should be fine. Problem now for EPR is their cost of capital has risen quite dramatically relative to pre-COVID. So it limits their options in terms of growth, which, like, the thing about REITs, it's almost like it's like a snowball, quite literally, it's a snowball effect. So like the more expensive your shares trade for, the better your cost of capital. The better your cost of capital, the more you can acquire, and the more you can acquire in competition with your competitors, because you can afford to pay rates that they can't. You can get, so if that property is really attractive, you can buy that property probably a lot easier than your competitor who has a higher cost of capital. And you won't have, let's say, a negative impact to FFO versus maybe your competitor would if they took on that deal. And let's say it's a great property, et cetera. So there's REITs out there that typically always trade. My head's going in too many directions at once because I want to get these ideas as we're talking about them. There's a REIT I already spoke to Dan about off camera. Yes, not yesterday. It's a couple of days ago. That is trading at a relative discount to peers. It's not really many peers. It's when I say that. We'll talk about PayPal in a second, but that's CCI. Where's their ticker? Yeah, Crown Castle. Yep. So Crown Castle International is currently trading at discount to peer. It's peer American Tower, which Dan, can you tell everyone why it's so ironic that American Tower is called American Tower?
I don't know why. Yeah, why is that one the international one, American Tower?
And then this one's Crown Castle International.
I mean, maybe it's beneficial to say American if you're, I don't know, you have a tower in Brazil or something. I don't know.
But it's the funniest naming. So this one, Crown Castle International. They changed their name to Crown Castle Inc. It's not Crown Castle International. I thought it used to be Crown Castle International. That's what CCI was.
International.
Maybe it was confusing the people. Yeah. And then they're like, no. Remove the international because we're like United States based. And then American Tower, you would think, oh, it's American Tower, it's based in the United States, blah, blah. Nope. No. That one is international. It's a lot United States, but it's global. It's very global. So Crown Castle International is trading at a pretty good valuation relative to peers. Dividend yield's actually quite high, historically speaking. And the reason, because there's always a reason, is you guys remember Sprint? You guys remember T-Mobile? Yeah, those guys. Well, since they merged, Sprint and T-Mobile, they don't need all those spaces anymore. They don't need two spaces on the same tower, right? They need one space on that tower. So that they're not going to renew that. So that's been a bit of a headwind, not a bit, a strong headwind. And that's kind of why the price is being punished so much. And then American Tower doesn't really face that same. I mean, it's facing the same problem, and you can see kind of it plateauing, right? It's plateaued, but it hasn't come down a lot, right? So, yeah, it's another one that's out there. BurgerFi stock is now at $1. Yes, BurgerFi.
It's too much.
It's too much. No, because they're likely, very likely, going to go to zero.
And even anything that's not McDonald's, don't care.
Well, some might argue, like, what was it, restaurant brands? I don't like restaurant brands too much. Like, McDonald's is so pricey. I'm so jealous of your cost basis.
Yeah.
Like, your original shares that you have on McDonald's are just like, oh my gosh.
Well, some of them I sold some over time. I'm not a penny pincher.
You didn't hodl it. That's basically
No.
like you should have hodled it. And
I'm not like strong, man. I don't live a frugal life. I like to spend money. So I don't at some of it's been, but
okay. But you still have some of it, right?
Yeah.
Okay. Yeah. Okay. In spirit, it remains. You know what? McDonald's bought back enough stock to make up for it, probably. So you still own the same percentage of the business as you probably did. That's the one thing about it. Thanks for the financial advice, Fabio. The financial advice.
I haven't bought any REITs this year. I usually buy like 2,000 of my Roth. I maybe throw in REITs. So I haven't bought any this year. I don't know. Last year was Alexandria and Vornado. So was 1 for 2. But
Well, Vernado maybe doesn't die.
no.
Just gets restructured, and then you kind of get to the new cycle, and probably take a while for it to recover. So it could be dead money for a bit. And dead money, that's usually a test for retail. If you can, it's unfortunate if you're in dead money, but it's like a test to see whether or not you can stick through something. It's a
I
better
see. Well, you see like people on like Reddit will be like, they'll literally ask, should I sell my stock because it's red and just buy it back so I don't have to look at it being red every day? I mean, that's a serious question. I'm on stock investing and dividend Reddit. So it happens. I'm like, you probably shouldn't buy individual stocks if
No.
you ask that question. Like if you don't feel comfortable looking at something red for like a year straight, just buy an ETF. Like, please, people, like.
Yeah, and well, not tax advice, but like then you can't. Well, maybe it's a really small allocation, but like you can't, you won't be able to write it off. So keep in mind. So I want to say that that tax loss harvest that I properly did with global payments. It wasn't like much, but still, like I just want to point out the execution. That was good.
Did you know? So the IRS has allowed. I found the case. They have allowed VU and SPY as it's not a wash. So they have said before, but it's all assessed on individual basis. So it's not like law.
It can change,
because they said they have different investment processes or something, how they're constructed. So they're not identical investments. So it didn't apply. The wash sale didn't apply.
Well, I did that with when I was dabbling into the Chinese stocks. Remember when I was doing that? And I did it with a Tencent and Prosus, Tencent and Prosus. So I sold Tencent at a loss, and then I grabbed that capital, put it into Prosus, and then I actually experienced a higher return when Tencent did recover that time. Because the discount on NAV closed for Prosus. So it was at a huge discount, and then the discount closed, and on top of the fact that it went up with Tencent. So that one was a good example, which is also, by the way, on YouTube and on portfolio updates, etc.
Yeah, everyone's about how to deal with credit or tax losses. No one wants to do videos on tax or gains in investing.
Yeah.
No one's going to watch that. They don't need it. No.
Yeah, exactly. What people, especially 2022, there's very few of the gurus that did anything.
But I feel like I don't know. I feel bad for people that make, I don't know, like some of these kids, like they had more money than I did at their age, and they're like, I'll see like a horror story of someone losing $100,000 or some guy on dividend Reddit. He lost $45,000 almost on SDIV, which is a degenerate dividend ETF. That was one that really got to me, because I was like, I felt so bad for him. And it's like, I don't know, like I didn't make that mistake. I made other mistakes, but maybe someone could have warned, I don't know, like someone could have been out there and be like, don't buy some of these ETFs that exist. A lot of these ETFs are trash. Like,
yeah,
maybe I try and help people, I guess, but
I don't know. I'd argue that's the hope, that they find alternate videos that kind of steer them in maybe a different direction, because they don't fall. Well, the thing is, the YouTube algorithm recommends them first, like financial education and all that stuff. But all right, we say it's a better burger concept. They said, now I'm at the truck stop and my rate is cheaper than Jeremy's. Someone went
I did find another truck stop investment after Travel America. So I was like, I was going to keep it going because like the first one did good, but it was like gambling, or it was casino slot machines in truck stops. It was Acell Industries or something.
Did they get acquired too?
No, I didn't buy it, but it went up like 16% this year at one point. So it actually would have been a good investment if I had done it. But they do like individual machines, like in the back of like the truck stops, and they lease the machines and share profits. It's kind of interesting business.
Yeah, no, there's so many businesses out there. It's
I love to
mind-blowing.
find that stuff because that's so interesting. Like something I didn't know exist because you don't have those in New York. We don't have that type of.
You made them illegal. Should you invest in BurgerFi? Nothing could go wrong. But actually, it can't go any lower. It can't go lower. This is the bottom. I've looked at it. The thing is, it has so much exposure. I mean, for obvious reasons, to lumber. So it's like it's not really real estate. It is real estate. It's like not really.
I looked at a competitor to them, and it's gone now. I don't know who bought it.
Yeah, there's a couple. There's a
It was
couple
like
out there.
CTT ticker, I think. It was a REIT that was forests, and they harvested lumber.
Yeah.
It's gone now. I don't know what happened to it.
They also have exploration revenue because there's potentially natural resources in their forests, and so they also get money from that. GO CXW when Republicans win next election, yeah, why not? That would be a sentiment play. CXW and GEO are both doing well. CXW doing well. GEO is kind of the struggling one. So CXW, I made a video talking, and I think Michael Burry got exposure to both, if I remember correctly. That CXW is the more, in my opinion, sure winner. GEO is it's a lot more leveraged. CXW was ahead of the curve in terms of switching out from the REIT status to C Corp status. They retained a lot of the cash flows, paid down a lot of the debt, focused on buybacks and no dividend, etc. And so you're getting a much less leveraged player in CXW. And yeah, if Republicans win, it's not going to materially change the business, really. But it will change the sentiment. Like short-term sentiment could just blow up there. Look at GDC. GDC. Why does that sound familiar? Is that the Ross Gerber one? No, that's not it.
Oh, good old Ross.
Oh my man, this is a small cap. Land develop. Oh, it's Genesis Land.
I love following Ross Gerber because I feel like he's my polar opposite investing. So I always feel like you always want to find someone that's like your complete opposite, and like so you can follow and think and figure out why do they think the way they do, because it's so different. But
okay, so Genesis Land Corp is like a real estate play in Canada, but I'd have to take a look at that. It's kind of weird. The performance is lackluster, so there's something going on here. Why haven't they been able to? Oh, maybe he's talking about this one. Oh, in which case, there's another company with that ticker, GDC, that came up. And for some reason, I Googled it. Yeah, I'm not touching this. What the hell is this? Oh, you're probably just asking just for like the memes because it's just went up 1,000% in a week. Great. Fantastic. I totally should have invested in it. Why didn't I think about that earlier?
Well, remember, Mo from Everything Money valued Paramount, and he didn't know about the Huang effect when Bill Huang did his thing. And
so he was probably like, wow.
So he went green when he did his little calculator at the end when he valued Paramount. He was surprised that it was all the numbers were green, and he didn't because his software. I mean, they can't make adjustments, so there was no adjustment for that artificial price jump. But it was pretty embarrassing. Well, for him, anyways.
This is why Fabio is a good investor, because he is colorblind. Yeah, because I can't see red. I can only see green. So it only looks good. I haven't talked about Vonovia. Vonovia is a heavily discounted European corporation that owns real estate. And because I mentioned one time that they're a REIT, but they're REIT-esque. They're not actually a REIT. And their yield is actually, I think, what, 8%, something like that, something crazy. I had some Vonovia and I sold it. I only bought a very small amount of Vonovia back when I told McBuda when I bought it, and then it was immaterial. There's a lot of like question marks about Vonovia, political questions that I think someone who lives or understands the German political system is more equipped than I. I know that there's a decent amount of European investors who have confidence in it, and it is definitely it's trading at a heavy discount to book, but with IFRS, they do actually carry book at market value. They reevaluate it in IFRS. So the current value of the real estate probably needs to be discounted quite significantly if things remain the way they do. So that's my commentary there, but just quick commentary. What gains no wash rule on crypto? Yeah, that's true.
Just don't report your crypto, right? No,
I lost it.
No 1099, no tax.
Boating accident. I don't know what you're talking about. No, in reality, guys, everyone, we should all just move to Puerto Rico. Just get all your capital gains, move to Puerto Rico, and then sell. And you're good. You're good. Just literally. Oh. So let's see. MAA is an A-rated REIT trading at a discount. Yeah, I think MAA is as well. But thing with MAA is relative to some peers, they're not trading at that much of a discount. The markets that they're kind of exposed to, I'll tell you this, Dark Knight, you actually are seeing, you're dragging me right back into the REIT conversation. Oh my gosh. Dan's like, no, please, no.
Like storage and apartments actually, I think, are interesting.
Okay. Well, this is apartments.
Yeah. Because I think they have, I mean, they're just a growing industry at this point in America, both of them, and they have room to expand. I'm not talking about this company, but well.
So MAA, thing with MAA is they have a strong presence in the Rust Belt, but the concern is about overbuilding in the Rust Belt because that's been the very hot market. I have an investment in ESS, Essex, because Essex regulation is on my side. Okay. I want more of that government regulation limiting production.
Yeah, if I was going to look at an apartment REIT, yeah, I'd want an area with heavy restrictions on building new houses. Yeah, a few other factors like that. Like in New York, we're struggling. Like there's a huge issue. There's not enough housing in New York. So it'd be something maybe for me to look at, like an apartment REIT in New York area.
The best part too about California is that tax liability is capped. So even if your valuation rises and rises and rises and rises, you buy and hold, you're fine.
Well, like I've said, like CubeSmart's my best REIT I've ever. So when people like that's as good as I've had. So it's just it's so hard. It's so hard to find like home run REITs. I don't know.
Lakers and 4 comes out with some points here. So 2.9 price to book versus 2.5 price to book on ESS and 2.9, 2.5. Okay, careful with price to book. But first of all, I'm trying to understand who's who. 2.9 price to book versus 2.5 price to book on ESS. And 2.27. So there's 3 price to books here. And there's 2 tickers. So I'm trying to understand that. Who's who? I know that 2.27 is AVB, but then there's 2 price to books before ESS. One of them belongs to ESS. Both of them are higher, so I get the point. Oh, first price to book is MAA. Okay, wait. Oh, that's Avalon Bay. Brain fart, complete brain fart. Avalon Bay is not MAA. Avalon Bay is this other one. Avalon Bay, I think actually that's the one that's trading at like if you see the stock chart, it was actually at a similar like price action to ESS. But yeah, AVB, Avalon Bay Communities, and ESS were both cheaper. MAA has that premium because it's in those attractive markets right now. So this is good to point out, but I'm going to caution on price to book for REITs because price to book, again, start asking those questions, like break down what that book value even means. How do we calculate that? And then how do we calculate the numerator and the denominator? Price is easy, but like, how do we calculate the actual book value? And so that's accounting book value. What does that mean? Is that the NAV? Is that net realizable value? Is that what is that? So it's going to be a function of the price that you paid for those assets minus any accumulated depreciation. So is that what you could sell it for? No, the answer is no. So there's that caveat there.
Some of the REITs I've noticed, like the ones that do really well, so like let's say like twice, like they've done 2x the market, like SPY. Because I would look at them, I'm like, well, what's the secret sauce with these ones? And it seemed like a lot of the ones that really perform well were located in areas where the property values were just going up in general, not their specific business. Like Rexford Industries in California, and then Toronto, which is a warehouse REIT. So they're operating. They have warehouses like any other REIT, let's say, but if the warehouse itself increases in value because the area is prospering, that's a benefit to the REIT as far as their operations. But I don't know, like, but is that luck more than anything, right? Like they just happen to be located in that area that's doing better in general.
Yeah, well, it's not luck. It's a function of the REIT has to choose that location. It's a function of location. They have to choose the right location.
Yeah. That was just one common thing I know, like the REITs that did really well just happen to be in those affluent, what you would consider an affluent area, like the coasts or California, or it's so hard. It's just so hard.
Yeah,
REITs is hard. I don't think people understand. Like it's really hard to find winners in that space.
Yeah, because you're betting on capital allocators. So with all CEOs you are, but like with the REITs management team, quite literally, that's what they are. They're managing assets. So they have to manage the assets well.
Yeah, they're diluting you, taking debt to buy more stuff that you hope makes you more money while maintaining what they already have. And
there is a REIT that I think has done an excellent job. Some people are actually pointing out one of them. This is not the one I'm talking about, but people are saying, "Oh, Realty Income," which they have proven over their long history to be exactly that, phenomenal capital allocators.
My concern with Realty, I've never bought them because their biggest holdings are gas stations, basically. It's always kind of concerned me with O.
Their gas stations?
Yeah, they own a lot of 7-Elevens, basically.
I'm not. Why the concern with the gas stations? Because gas stations, if anything, it depends on where the gas stations are, because they can be repurposed. Like it's the land that's really valuable, and well, Realty doesn't get them at like as great valuations like National Retail. National Retail gets them at pretty insane valuations but that's their strategy. So National Retail Properties is trading at a relative discount to Realty Income, but they're like two different strategies. They're both triple net. National Retail just focuses less so on investment grade. They're not like a Store Capital that like purposefully went after non-investment grade, but they're not a Realty Income or an Agree Realty, which
Agree. I like Agree's portfolio more than Realty Income because it's more big box stores. I don't know, that I think makes more. I just like the makeup of their properties more.
That's the one that I'm accumulating. So I'm getting into that one more and more and more. I'm exiting Realty Income and going into Agree Realty. They kind of fit the profile I like. So I like that. I'm expecting low volatility relative to its peers, and from both a business performance standpoint and from even the share price standpoint, I expect them to consistently trade at a premium to peers, which has historically been the case. With Agree Realty also getting a very much family operated business. So the Agree family basically runs it and they're incentivized alongside you. They're at that good size where they can still reasonably find good opportunities every year. And while their rent escalators aren't going to be as high than something like National Retail Properties, you can probably sleep way better at night with Agree's tenants than you can with national retails. Not saying like national retails are like bad, by the way. They're not. It's not bad. Like Store Capitals was a lot more kind of but Store Capital was managing it really well. But yeah, Cardano undervalued. Arthur. Is Cardano undervalued? Y'all never seem to know the answer. Yeah, that's true. I have no idea.
What is? I don't know what that is.
That's an altcoin.
Oh,
It's one that
okay.
Meet Kevin was huge on, by the way. So
God, that dude.
good question, Rob. I'll get to that one in a second. Mighty Healthy says QYLD. I want Dan's opinion here, and then Dan.
I spent
I
on
want
one
you
of
to
our
tell me how
exit
to buy it.
liquidity podcasts. I spent like 30 minutes talking about covered call ETFs. So it's just I don't like any of them. I don't think they're going to perform well over time, over long periods of time. I don't understand why you would buy them. I guess if you're like a senior citizen and you needed income now, I guess that would make sense for one of these because you're maximizing your payments. But for someone, if you're watching this and you're like 20, 30-year-old person, like I don't understand why you would buy a covered call ETF like at all. There's just so many better options.
Dividend.
Yes. It's just going to be like over time, there's going to be months where those covered calls get called, and you're going to lose assets in those portfolios. So just longer periods of time, it's going to happen more often. And I don't know. Most of them are just a slow trailing bleed off. Like JEPI is a mutual fund before it became an ETF, and it's the same. It's just a slow trending downwards.
And
that's what they're all going to do. So
you found JEPI's prior performance, didn't you?
Yeah, I don't remember. It's just, what is it called? It's JEPI Mutual Fund. I don't remember what it's called. But
yes. Retail is always trying to find the easy way out.
Every time they come in, they're like, just go for the highest yield stuff. When dividend investors, they all have Verizon. I don't know why that's such a darling. They have Verizon, JEPI, and then it's kind of a mixed bag of some other stuff. But
I got crap for saying Verizon was not attractive when I made the videos on Verizon because Buffett was in it. So then, he's no longer in it, by the way. So all of you who said that, which you probably aren't watching my channel anymore because you saw that video and you're like, yeah, stupid.
Well, it's like, if you don't buy dividend investments that are beating inflation, you're literally losing value as you own them. Like if you're getting a 2 or 3% growth in the dividend, I mean, you're literally losing value as you hold it because inflation, I think, is 4% average over long periods of time. It just makes no sense. Go buy bonds at that point. At least then you're more protected. But they're just weird investments, I think.
Yeah.
If they can actually calculate like the compounding of a dividend, like say something that pays a 2% that's growing at a 9 to 12% CAGR. I mean, they don't do those calculations to see. You could have a yield on cost in 10 years of 12%. So it's like when they're like, oh, well, why are you buying Lockheed Martin? It's fair value right now. It's like, well, I'm thinking I can own Lockheed Martin in 10 years with a 12% yield. So I'm thinking about it differently than someone who's like, well, it's not going to appreciate. The stock price won't appreciate this clip or whatever they want to say. So if they want that discount, like Paul, you're just going to end up buying shittier companies than I buy. I'm going to buy better quality companies than you because I don't have to take such a steep discount.
No, and you don't. I don't think there really is a compromise. It's just like their methodology for applying discounts and projections is completely moronic.
Yeah,
but no, in principle,
I keep commenting on their channel. They do discounts so severe. The company has only seen those drops in like recessions, and then I get shit from people. I'm like, yeah, like they'll be like, oh, it needs to drop 40% this stock. I'm like, okay, it's only done that once in the last 20 years, and it did it in 08. Like, so the country's got to go to hell for you to buy this stock. It's just useless. Like it's not bad investment advice. It's just useless. I think, but
Invite small Gabriel. We'll talk about that in a second. So thoughts on LNY and AGNC? How do they compare to these other REITs? So Rob, I don't know if you're still around, but if you are, if you're relatively new to the markets or new to REITs, I would strongly suggest reframing from involving yourself with mortgage REITs until you understand them a bit more. Because the thing with mortgage REITs, completely different strategy. In fact, there are some strategies that you can implement to eke out more yield, but they're very complex, and they're not really for the newer person. They involve using options, using selling puts, selling calls, and that also requires a lot of familiarity with each of the stocks. Now, they all tend to degrade over time, except for a couple that have not done so. And general rules of thumb I can give you just to kind of get you started, or anyone who's interested in just getting started. These aren't, again, I'm not going in depth here, but you want to take a look at book value, right? For these guys, it's a bit more, it's a bit more accurate. So let me actually illustrate with NLY, for example. I think NLY, by the way, pays monthly, which you shouldn't care about, but it's usually the problem with this one is it's a retail trap. It's the one they go to because it pays monthly. I think it's this one. I could be mistaken, but this is going to be actually. You see, before I was kind of dogging on banks and all that stuff, which here for mortgage REITs, take what I said and almost turn it around. When you get it under the price to book, general rule of thumb is that's a good opportunity. That's a good time to pick up shares. And the heavier the discount, keep in mind if it's business related, if it's the individual business problem or if it's the sector problem, you got to be aware of that. So like you see COVID, it dipped down quite strongly. And then post-COVID in 2022, actually more recently, you got some really strong dip opportunities there. You overlay that, let's pull that with NLY on the actual price here to illustrate this point. So you have this moment here in it was right here, October, I think, right here, October. And the recent drawdown was, October. So October was an interesting point to accumulate, but you can see the general downtrend in the share price. Again, there's very few of them that have actually a positive uptrend. Almost all the return is from the dividend. So, but again, going back to my point before I get carried away or talking about something else, is generally below price to book is good. And that is because the book value for these guys is a lot more accurate in terms of like getting an idea of the value versus an equity REIT, because equity REITs are off the book value is the accounting value. So it's a function of what we paid for a property minus accumulated depreciation. These are loans, right? So it's a lot different.
Oh, I found the ticker for the JEPI mutual fund. Do you want to pull it out?
Oh yeah, just have to say, just Slurpees, love it. It's the humor. It's great. All right, so yeah, what's it called?
It's JMSIX. SSIX.
Yeah, that was my slip of my fingers.
So these people say we'll see what JEPI does long term. Well, here you go. That's what's going to happen to JEPI. So,
woo! Wow, look at that curvature right there. Look at that. Look at
they
that.
had a good shot at it once, I guess. So,
and then we can overlay that with JEPI.
It's the same strategy. So,
I put JEPY. Oh, whoa! It's so different.
The thing they don't realize either, JEPI was a top 10 ETF for inflows last year. So that's not going to. So they're like, well, the price held up. It's like, well, yeah, there was a crap load of inflows. That's not going to sustain itself. But it's already there. It goes. See, it's already doing its trending down, and
it will continue. There's a question that I'm bearish on Walgreens Boots Alliance. I haven't made a video in a long time. But I stand by what I said in my video, whatever I said. I think I remember it being something along the lines of they've had deteriorating internal rates of return, and so the market's assigning a discount, deservedly so, because business performance is deteriorating and margins have been deteriorating for quite some time. I believe that was my point in the last video. It's been
See,
a
here's
very
a good
long
example
time.
for me. The dividend growth is not even 1% per year now for this company. So it's like
That
you're
follows
just
in line.
you're losing. You're just going to start. You're not. Inflation's eating you alive if you own Walgreens Boots. Like if you're a dividend investor, like
Well,
like. What's the point of owning it at this point? Like I wouldn't buy more. I would just like someone could just keep what they had, but like reinvesting in it would make no sense.
Mighty Healthy has a point there. Went to Walgreens, didn't see any boots.
Yeah, I saw the Theranos movie, bearish on them. So
yeah, I can't believe they fell for that crap. So I don't remember Dark Knight being. I mean, it actually rings a bell. So you're probably referring to my last video, which was a long time ago. But yeah, dividend investors, enough said. All right. So I think with that being said, I think we can close off because I don't see any more questions. The walls weren't green. Thank you so much. Inflation, but doesn't even know what deflation is. My wife's boyfriend's girlfriend does that. Oh my gosh. You guys are funny. All right. With that being said, I think no, I didn't see that one. Revenue is better than book value. It's better than profitability.
oh no.
That's a great that's a great summary of today's video. All right, everyone. That oh, where'd it go? Oh, come on. This is a summary of today's video or live stream. Live by these words. Revenue is better than book value, and book value is better than profitability. That's all you need to know.
I'm gonna write that down.
Yeah, write it down. All right, guys. I'll be seeing you guys on the next one. Thank you guys so much for watching, and yeah, we'll be seeing each other.